The foundations of contemporary finance rest on a principle that transforms intangible commitments into the currency of daily life. In essence, the balances displayed in personal accounts across the world are not backed by equivalent physical assets held in vaults. This reality stems from a long-standing practice embedded in economic systems, where institutions extend credit far beyond their immediate holdings, fostering growth but also inherent vulnerabilities. To grasp this, one must trace its origins to earlier eras when commerce relied on tangible commodities like precious metals. During the Middle Ages in Europe, societies operated under a monetary framework dominated by gold and silver coins. Merchants and landowners faced constant risks from theft and loss when transporting these heavy valuables over long distances. As trade networks expanded across regions like Italy and the Low Countries, individuals sought safer alternatives. They turned to skilled artisans, particularly goldsmiths, who maintained fortified storage facilities for their craft. Depositors would entrust their metals to these custodians, receiving in return handwritten certificates attesting to the amount stored. Over time, these documents gained acceptance as a convenient medium of exchange, allowing transactions without the need to physically move the underlying assets. This shift marked a pivotal evolution in monetary practices. Goldsmiths observed a pattern. The majority of deposits remained idle for extended periods, with only a fraction reclaimed simultaneously. Leveraging this insight, they began extending loans by issuing additional certificates against the same reserves. For instance, if a goldsmith held reserves equivalent to 1,000 units of gold, they might circulate claims totaling 1,500 or more, charging fees on the excess. This approach generated profits from assets that were largely dormant, but it hinged on the assumption that mass redemptions would not occur. In practice, it enabled the expansion of credit, stimulating commerce and investment in ventures such as maritime expeditions or agricultural improvements. The implications extended beyond individual enterprises. As these methods proliferated, they laid the groundwork for formalized banking institutions. By the 1600s, European powers recognized the potential to harness this for state purposes. The establishment of the Bank of England in 1694 exemplified this adaptation. Facing fiscal strains from prolonged conflicts, including naval wars against continental rivals, the English monarchy needed substantial funding. Private investors formed the bank, advancing loans to the government that exceeded actual deposits, in return for exclusive privileges like note issuance. Repayment drew from public revenues, such as excise duties on goods, effectively distributing the burden across society. This model influenced fiscal policies, allowing rulers to pursue ambitions without immediate tax hikes, though it sowed seeds for long-term indebtedness. Across the Atlantic, similar dynamics unfolded in the nascent United States. Colonial and early Republican banks issued paper notes backed by specie, but operators soon inflated circulation beyond reserves to meet demands from a growing economy fueled by westward expansion and industrialization. This led to periodic instabilities, as seen in the panics of the 1800s. During these episodes, rumors of insolvency prompted crowds, farmers, shopkeepers, and laborers alike, to queue outside branches, demanding conversions to hard currency. When reserves proved insufficient, failures cascaded, wiping out savings and disrupting trade. Rather than dismantling the system, authorities reinforced it through centralized oversight. The creation of the Federal Reserve in 1913 aimed to provide stability, acting as a lender of last resort to prevent widespread collapses. Examining the mechanics in a contemporary context reveals how this principle operates today. Consider a scenario where an individual deposits $100 into a financial institution. Regulations once mandated retaining a portion, say 10%, as a safeguard, permitting the remainder to be loaned out. The borrower might use those funds for purchases, leading the recipient to deposit them elsewhere, where the process repeats. Through successive iterations, the initial sum could support loans totaling nearly $1,000, amplifying economic activity. However, this multiplication relies on credit chains, where most of the expanded money represents obligations rather than tangible reserves. A significant shift occurred in recent decades. In the U.S., following economic disruptions like the 2020 pandemic, the Federal Reserve eliminated mandatory reserve ratios, setting them at zero. This change decoupled lending from deposit levels, raising questions about controls on credit expansion. The primary restraints now stem from international standards, particularly those developed under the Basel Accords. Originating from collaborations among regulators at the Bank for International Settlements in Switzerland, these frameworks emerged in response to past turmoil, including the 1970s oil shocks and the 1980s debt crises in Latin America. They emphasize capital adequacy. Banks must maintain sufficient owner equity to cushion against defaults. For a $100 loan deemed high risk, an institution might need to allocate $8 of its own funds as a buffer. Additionally, liquidity mandates ensure access to quick-sale assets like treasury securities during stress periods. This regulatory evolution alters the sequence of banking operations. Institutions originate loans by crediting borrower accounts digitally, effectively generating new money upon approval. Only afterward do they verify compliance with capital rules. Consequently, the bulk of circulating currency, over 90% in many economies, consists of commercial bank liabilities, not central bank-issued notes or coins. This structure ties money supply growth to borrowing appetites, influencing everything from business investments to consumer spending. The long-term effects of this system are profound and multifaceted. One key outcome is the erosion of purchasing power through inflation. As credit proliferates, the increased monetary base dilutes value, pushing up costs for essentials like housing and food. This isn't merely a byproduct of market forces. It's intrinsic to a setup where new funds enter as debt, requiring perpetual expansion to service interest. Historically, this has exacerbated social divides, as seen in the Gilded Age, when rapid credit growth enriched industrialists while laborers grappled with rising living expenses. Another consequence is the inescapability of debt at systemic levels. Since principal and interest must be repaid, but interest isn't created alongside the loan, the aggregate debt perpetually exceeds available money. This dynamic forces ongoing borrowing, defaults, or restructurings, as evidenced in sovereign debt cycles from ancient Rome to modern Greece. It also concentrates influence among financial elites and policymakers who leverage the system for large-scale initiatives, funding infrastructure, social programs, or military endeavors without direct fiscal accountability. Asset owners, including those holding property or equities, often gain as inflation elevates nominal values, widening gaps between classes. Human stories underscore these patterns. In the 1930s Great Depression, triggered by speculative lending in the 1920s stock boom, millions lost homes and jobs when banks failed en masse. Farmers in the Midwest, already strained by falling crop prices, faced foreclosures as credit dried up. Governments intervened with reforms like deposit insurance, yet the core mechanism persisted. Echoing this, the 2008 crisis arose from overextended housing loans bundled into complex securities. Homeowners in suburbs across America, enticed by easy credit, suffered evictions when values plummeted, while bailouts preserved institutional stability at taxpayer expense. Globally, variations persist. Advanced economies like those in the Eurozone or Japan have minimized reserve requirements, relying heavily on Basel protocols to manage risks. In contrast, developing nations such as India or Brazil employ higher reserves, often 420%, as tools for monetary policy, curbing excessive lending amid rapid urbanization. Nonetheless, all adhere to the Basel overlay, illustrating a unified approach shaped by shared experiences of volatility. Reflecting on this history reveals enduring tensions. The practice, refined from medieval innovations to digital ledgers, enables prosperity by mobilizing idle resources, but invites fragility when trust falters. Crises from the 19th century bank runs to recent subprime meltdowns highlight how over-reliance on credit can unravel societies, displacing families and stalling progress. Yet, responses typically involve enhancements rather than overhauls, prioritizing continuity. For individuals, this awareness prompts reevaluation. True security lies not in account balances, which are ephemeral entries in a debt-based ledger, but in durable assets, education, productive land, or diversified skills that withstand economic cycles. Recognizing debt's role as the engine of growth, yet a potential trap, encourages prudent management. Inflation, far from random, acts as a subtle tax on savers, urging strategies like investing in inflation-resistant holdings. Ultimately, this framework isn't destined for collapse, but its sustainability demands vigilance. By understanding the interplay of promises and regulations, one can navigate toward greater autonomy. Economic history teaches that while systems evolve, the balance between innovation and risk remains constant, shaped by human decisions and collective beliefs.